Good evening, everyone. Thanks, Kabraji, for setting the stage for me. Uh, Maybe let me start with a basic question. Who have not heard about Gift City in this room? Is there anyone who has not heard about Gift City? Okay. Okay, let me ask a different question. Who has not visited Gift City from this room? My God. I, okay, who have visited Gift City? I think that's maybe lesser hands, I guess. Okay, hand-picked of people. Okay, excellent. So maybe I'll give you some snapshot of what Gift City is. It is as the name says, gift. It is not really a gift to the society in that sense, but it's the Gujarat International Finance Tech City, as we call it. So it is basically, so what is the thought process of this entire zone, right? It's essentially a free trade zone which is created in the lands of India, which allows people to trade freely when it comes to foreign clients, foreign exchange, etc. Right? This is first of its kind for financial services. So you must have heard about SEZ, Special Economic Zone, which have been prevalent in the country for quite some time. This is very similar. This is actually an SEZ, but this is an SEZ which is catering specific to financial services. You would have heard about IT, ITES, SEZ, multi-service SEZ, etc. But there has never been an SEZ which has been very focused on financial services. And what has been the thought of this? The thought of this is really allowing a gateway for India to actually have foreign clients who are otherwise doing business in India set up shops here. Or there have been so many situations where Indian people, Indian firms have set up overseas presence to do a similar sort of business. And then the thought came that why not try and create a similar zone in India, like what Singapore is, what Mauritius is, right? So that you can try and get that same ecosystem here within the probably the land boundaries of India. If we really see what are the various opportunities which are there in Gift City today, right? The opportunities are both from an inbound perspective as well as outbound perspective. And we will discuss some of this in detail. So as far as inbound is concerned, one of the most popular one is people setting up fund and fund managers in Gift, right? Who are fund managers? They are basically pooling vehicles which have raised third-party capital, and there are professional fund managers who manage that capital, and that gets invested in India. These could include both public market funds, the FPIs that you see who exchange, do investments in equity and derivatives on the stock market in India, or it could also cover private equity funds, which are funds which invest in unlisted companies, private companies, or it could cover venture capital fund or credit funds, right? That's what the entire regime is today, allowing people to set up funds in Gift City. And there are certain benefits, nuances, important areas to be considered. Considering that we need to create an ecosystem there, the first and the foremost requirement to create an ecosystem is to have a banking system there, right? You can't do probably trade in a particular zone unless you have the entire banking set up there. So there are banking entities which are set up in Gift City, what they call as IBUs, which allows you for Indian banks as well as foreign banks to set up presence there, undertake trades, undertake transactions, etc. Then as you migrate, there will be capital market intermediaries, right? Like stockbrokers, stock exchanges. There will be trading which has already started in Gift City, etc. Right? So that's the capital market intermediaries. As you also move along, then there will be finance companies. Finance companies are very similar to NBFCs that we have in India, right? And similar sort of setup has now been also permitted in Gift City, where you can set up finance companies which can lend to Indian businesses, gift businesses, overseas businesses, etc. There is a very big maybe push to have people set up aircraft leasing business there, right? One of the big opportunities today is that as the Indian aviation industry grows or Indian corporates grows, there is always a continuous need of having aircraft on lease, right? Today, some of these aircraft have been leased directly from Ireland or from some of the geographies. And then we thought that why not, at least to cater Indian clients, set up a regime in Gift City where you could try and give a very similar level playing field for anybody who wants to set it up. And that's where the aircraft leasing companies have also been given a platform to set up something in Gift City. And there are fintech, payment services, foreign university, and this list is growing, right? If you really see how it started originally and how the things are today, there are lot many new services or not many new opportunities which are getting in Gift City probably every day when we speak. Just to give you a very broad overview on the level of activities right now, right? We see as on today, there are 27 banks who have been set up with a total probably banking size of $60 billion. There are capital markets. So for example, the entire XGX Nifty trading is now happening in GIFT. So the volume there is increasing. It's overall $79 billion. Funds, right? If you see, there are 114 funds which have been set up in GIFT, fund managers who have set up in GIFT, and which have raised close to $8 billion till date, right? Which is a massive number when we look at the success of the regime. Then there are aircraft leasing companies, there are fintech companies, there are insurance companies, etc. Right? So this regime, as we see from June 23 to March 24 itself, you have seen a significant growth, and this is just going to become bigger, right? Now, if you really see what is this jurisdiction, and it's a little nuanced in terms of how and in what form this jurisdiction has been set up under Indian law. Okay, so as you know, India, for any entity to invest into India as well as invest outside India, you need to comply with what we call as a foreign exchange guidelines, right? The FEMA guidelines, and then there will be tax implication which will be there. Both of these are very important for a particular entity to be compliant as far as the business is concerned. So if you really look at Gift City entity, it's actually a hybrid entity. When we say hybrid means it is, because it's a foreign zone, as far as FEMA is concerned, it is actually a non-resident vehicle. So it has to comply with all the rules and regulations of a non-resident entity under FEMA, whether it be for inbound investments. So for example, any entity investing from GIFT into India has to comply with FDI rules, has to comply with FPI rules, and all those conditions which are otherwise applicable to any other foreign like a Singapore, US, Mauritius, Cayman, all of those conditions needs to be complied as it is by the GIFT vehicle, right? But at the same time, from an income tax perspective, because this zone is still within the land boundaries of India, from an income tax perspective, it is actually a tax resident. So unlike a Singapore or a Mauritius company, which is a non-resident, and there are different rules when it comes to taxation of non-resident, for GIFT vehicle, it is actually a tax resident in Indian law. And therefore, the need to give a lot of tax incentives and maybe tax holidays to try and bring that tax to a lower rate. So therefore, it is a very interesting regime, because on one side, I'm wearing a cap of a non-resident as far as FEMA is concerned. But from an income tax point of view, I'm a resident. And therefore, both of these needs to be probably looked at together to see what are the various implications that a GIFT vehicle could have when they're setting up an entity there. So I don't know on difficulty of taxation, as they say in India, taxation is not easy, and that's why we see this population growing and even more. But I think the expectation generally is that there is going to be maybe a separate focused cell that will look at the taxation of some of the GIFT vehicles, so that the provisions, the regulations which have been laid down will be probably implemented in a more practical manner and more, maybe I would say, focused manner. But right now, we have not seen such active, maybe I would say, tax assessments that have happened for some of these vehicles. As of now, we have not seen any red flags, and we are hoping that that will continue, because that is one of the big, I would say, driver for a lot of people to set up that presence there. Because so who are the people who are trying to set up here, right? Just if I were to step back. So these are the people who are otherwise have, say, presence in Mauritius, Singapore, US, etc. They are trying to come here, right? These are all Indian groups, Indian people, or some of the foreign groups trying to set up. So they are, at the end of the day, comparing like a level playing field, that if I would have come from Singapore, what would be my taxation from India and what could be my maybe compliance, litigation, proceedings, etc. that I need to go through versus if I am in GIFT today, I'm an Indian resident, how will I be treated? So at least whatever that we have been hearing generally is that there will be a good level playing field given, and therefore to that extent there should be some comfort that may be available on ground level basis when it comes to litigation. One of the other important point is that because this is a foreign entity, the transaction that happens in GIFT City is in foreign currency. You can't transact in rupee in GIFT, except for very specific items on meeting certain expenses, if you're setting up, etc. But all the principal transactions in GIFT has to happen in a foreign currency, whether it is dollar, euro, pound, anything that is fine. Okay. So maybe I'll touch upon a little bit from a FEMA perspective because we spoke about FEMA. So while we spoke about inbound, at the same time, it is very important to understand how the outbound will work, right? Because a lot of these entities which are trying to set up presence in GIFT are Indian corporates, Indian groups, Indian individuals, right? Now, if you all are aware, in August 2022, there was this new foreign overseas investment guidelines that got implemented, and it had number of, I would say, new conditions, restrictions on who can invest outside India, especially for investment in financial services sector. And GIFT City is actually for financial services sector. So for example, if one were to set up an entity outside India, which is engaged in financial services sector, then the Indian entity which is investing has to have a 3-year track record. If that Indian entity is maybe regulated by an Indian regulator, then you also need an NOC from that concerned regulator, right? And only then you can set it up in that sense. Also, similar provisions are applicable for a GIFT vehicle. So if an Indian group which wants to set up something in GIFT, the first thing that we need to test is whether the investment will be an ODI or an OPI, which is a direct investment or a portfolio investment. If it is a direct investment, then one has to see whether the Indian entity which is making the investment, is it engaged in financial services or it is not engaged in financial services, right? So for entities which are engaged in financial services, there is a 3-year track record that the Indian entity has to comply with before they are eligible to make investment under the automatic route. Also, there is a requirement that that financial services entity has to take an NOC from the concerned regulator that they are governed with. So if it's an NBFC, then they need to go to RBI. If it is a stockbroking entity, then they need to go to SEBI, etc. But one good thing that they have provided specifically for GIFT is that if you apply to a concerned regulator, the regulator has to give you an NOC within 45 days. And if the regulator does not give you or there is no response within 45 days, it's a deemed approval. So which is a very positive thing, because in a normal case, when you were investing in, say, an entity outside India in Singapore, you had to formally wait for that approval to come. And that approval sometimes could have taken 2 months, 3 months, 6 months, etc. And that was significantly delaying the ability for that Indian entity to set up in the overseas jurisdiction. Whereas for GIFT, they have given this concession that so long as you have a 3-year track record and that you apply to the regulator, if the regulator does not respond to you or give an approval within 45 days, then 45 days is treated as a deemed approval in law. For entities which are not engaged in financial services, now this is a very interesting one. For entities which are not engaged in financial services, what they have said is that you could actually set up a presence in GIFT, and there you don't even need to comply with the 3-year track record. So for example, if you are a group which is into, say, manufacturing, or you are engaged in any other services like consultancy, etc., when you set up something in GIFT, you can actually set up without having a track record. Because you're not regulated by any other regulator, there is no real delay or you need to go and comply with any regulators or regulations per se. So that is a relaxation which is currently available in GIFT. That unfortunately is not available if you were to set it up somewhere, say, overseas, because there you need to have a 3-year track record, irrespective of whether you're financial services or not financial services. The third aspect is OPI. Now, this is very important in OPI, what do you mean by OPI, right? Now, for example, for any Indian individual, when an Indian individual has to make investment in an overseas country, they can only make investment in an overseas listed entity or a listed securities. An unlisted security is not been allowed under OPI today, right? The OPI definition got amended in August 22, which says that an Indian entity or an Indian individual can only make investment in overseas listed entity. In GIFT, they have given some bit of relaxation. They've given relaxation to the extent to say that an individual could make investment in an entity engaged as a fund manager, or they could invest in an entity which is a fund, which will qualify as an OPI, and that comes without restriction. So it also kind of allows people to raise capital from Indian participants and invest outside India. So that is one relaxation that has been allowed in GIFT, which is not otherwise allowed when you are investing in a country like Singapore or say US. If we were to really go from taxation standpoint, so as we discuss, a GIFT City vehicle is a tax resident as far Indian law is concerned, and therefore all these concession and exemption becomes relevant for that entity. So currently there is a 10-year tax holiday that is available. 10 years out of 15 years is a tax holiday available. It is available for a consecutive 10 years. You can't do a pick and choose out of 15. So once you elect, you have to continuously take it for the 10 years. You may decide when you want to select it out of the block of 15 years. But once taken, you have to follow it for the next 10 years continuously. There is a MAT, what we call as an AMT at 9%. But if you are a company and if you have taken the new regime of taxation, then MAT is also not available, because MAT has been abolished for any entity who has adopted for the new regime of taxation. As far as dividends is concerned, for a foreign investor, a dividend tax rate is 10% flat. And as far as interest is concerned, so if there is a foreign entity which has given loan to a GIFT entity, then any interest paid to such foreign entity is not subject to any withholding tax. So these are the benefits that they have given. GST, there is complete exemption of GST. Whether the transaction happens outside India, whether the transaction happens from India to the GIFT vehicle, there's a complete exemption from GST. And then there are certain state subsidies on IT, ITS that the Gujarat state government has given. And also there is exemption on custom duty and various other things if you import all the various, say, laptops and other stuff in GIFT City directly from outside India. So moving on to the various opportunities that we see in GIFT City today, right? One of the most popular one, as we see, is what we call as a fund management entity. Now, if you really see, there are multiple boxes in the fund management entity. So the middle box, which is a triangle, right? That's the main pooling vehicle where all the capital from various investors are pooled. Currently, this entity can take capital from foreign investors, while the law allows for even Indian investors to invest. IFSC as the regulator has been a little cautious for allowing Indian investors to invest in a GIFT fund and which is investing back into India. So they are currently not encouraging that thing unless that money is coming as part of your sponsor commitment or as part of the requirement which is there in the regulation. The fund needs to be managed by a fund manager, right, which is the registered FME that you call it. This is also very similar to what we see as an AIF in India. An AIF in India has a pooling vehicle, which is AIF. Then it has to have a manager. Both of these are required from a SEBI perspective. India still do not have a concept of a self-managed fund. So there is a requirement to have a manager which manages the fund itself. Depending on the type of the vehicle, so for example, if you are a trust vehicle, then you need a trustee. If you are an LLP, then you don't need a trustee. And then there will be foreign investors who will come into this fund vehicle. They will subscribe to units. They will get what we call as a units pursuant to the investment, etc. And this fund can then invest directly into India. It can invest into an Indian AI, and it can invest into even outside India, depending on the ultimate objective of that fund. So as per the regulation, and this is something which IFSC has probably studied multiple regulations globally and tried to adopt similar regime in India as well. So globally, if you really see how funds are set up, globally people actually regulate the fund manager. They don't regulate the fund so much. Whether it be the Singapore authorities, whether it is the US authority, etc., the license is actually given to the fund manager. In India, SEBI has taken a slightly different approach. In India, SEBI actually gives the license to an AIF and not to the fund manager. But GIFT has taken, or IFSC has taken more in line with what globally it is a prevalent practice. So the license is actually to the FME entity. So if you see the gray box on the left, let me just try and see if I can. Yeah. Okay, so the gray box on the left, which is the registered FME, is the entity which needs to take the license. And that entity can then float multiple schemes. There are category 1, category 2, category 3 that we'll discuss in a while. To own the registered FME, so for example, if the registered FME is owned by the foreign entity, then there is no problem because it's all overseas to overseas zone, so there are no restriction. But if an Indian group has to own this registered FME, then all of the FEMA implication that we just spoke about 5 minutes back, whether ODI, 400% of net worth, 3-year track record, all of these comes into picture, right? And that is applicable and one needs to comply with to own the registered FME. The fund is a simple vehicle. It's a classic trust, which gets maybe a letter registration from IFSC, and the investors are the one who get the units into this particular vehicle. So if we see what are the different types of fund management vehicle which are available in GIFT, there are 3 categories that are currently available. What we call as an authorized FME, which is for the smaller fund, more like venture fund, etc. There is a registered FME, which is the non-retail one, which is more of accredited investors and institutional investors, etc. And then there's a registered FME, which is retail. So the most popular is actually the second one, which is the registered FME, which is more on non-retail that we see today being present. Out of the fund schemes, venture capital schemes are there, and more are the restricted schemes, which is the residuary basket, like a Cat 2 type of a scheme, which is in India. And then there are retail schemes which invest more from maybe listed stock to derivatives, etc. And we will talk about family investment fund. I know there has been a lot of discussion around family investment fund, and there is a current view on how family investment fund is currently being looked at it. So very quickly, there are hosts of requirements to set up a fund manager entity. All of these requirements is to set up an FME, right, a registered FME as we call it, which is basically nothing but the license entity. And if you really see, it requires, so if you look at authorized FME, an authorized FME required a $75,000 minimum net worth, whereas a registered FME requires a $500,000 net worth. The reason for this net worth is also that they wanted more serious players to be set up in GIFT and not anybody who just wants to come and set up the presence. So they have kept like a benchmark for that. And for retail, the benchmark is much higher. It is $1 million. So that is the minimum net worth. There is also a requirement on what is the size of the investors that they are looking for. So if you see in the registered FME, they are asking for an investor to commit minimum $150,000, whereas for the authorized FME, the bar is slightly higher. It's minimum $250,000, right? Categories of scheme is very similar, which is basically similar to what we see in Bombay, which is VC, private equity fund, credit funds, and maybe listed market investments as well. Also, there is a lot of, I would say, requirement to have presence in GIFT. Okay, and this is very important, is that the IFSC as a regulator is very clear that they want to make sure that people who are setting up presence there are also having commercial activity and commercial substance there. They would not encourage, or from a tax perspective, it is not encouraged that you just create a paper entity and everything else is actually done from Mumbai, right? That's not going to work from a practical standpoint. And therefore, they have prescribed the minimum number of people and what should be their experience in terms of they being based in GIFT. So if you really see, based on the type of license, you may require 2 or 3 people. The 2 people actually comprises one of as a principal officer. A principal officer is somebody who has an experience of minimum 5 years in doing investments, and that CV has to be very clear in terms of what is that 5 years of experience that he spent. And one is a compliance officer. Compliance officer is somebody who has spent time in compliance, accounting, taxation, finance, etc., could comply. You need both a minimum principal officer and a compliance officer in GIFT if you're going with a registered FME license. If you're going an authorized FME, then there is only 1% requirement, which could be the principal officer itself. And for the registered FME, which is the retail one, you require 3 people, because for retail, the bar is always higher because of the general sensitivity involved when you're handling retail money. The requirement is actually to have the principal officer and compliance officer based in GIFT. Okay. What do you mean by based in GIFT? Means those people need to be employed by the GIFT entity. They need to be actually having their home house in maybe state of Gujarat. So they're not right now being very insistence of having in GIFT. But even if you are staying in Ahmedabad, from Ahmedabad, it's a 30-40 minutes drive to GIFT. So long as you are staying in that region, it is fine. But you need to predominantly be spending time in the GIFT zone itself, because that's how they have categorized means based in GIFT. And that's what they want to do, is they want to increase the economic and commercial activity in GIFT and not just have people employed and not being present there. And this actually, if you really look at it as a comparison, is very similar to what it is there in Singapore, right? So Singapore also has a very similar regime where, which is the MAS, which is the Monetary Authority of Singapore, actually requires you to have two people. One is a CEO and one is a compliance officer. And both of these need to spend significant time in Singapore. In fact, IFSC authority approves who will qualify as a principal officer and compliance officer. So you need to submit as part of your application the CV of the principal officer or compliance officer. They will look at the credentials of those individuals, approve it that it is okay to do. And this is also very similar to what Singapore has done. So they have actually adopted some of the good practices in other geography, just to make sure that we are able to maintain that bar as well as give that global platform for people who are coming and setting up presence in IFSC. So there is also a requirement of having a skin in the game, which is also very similar to what we see for a Mumbai AIF. So even for Mumbai AIF today, there's a requirement of having a 2.5% of the corpus or 5 crore, whichever is less, for maybe an unlisted one, and for a listed one, it's 5% or 10 crore, whichever is less. So they have also kept a similar thing. But what they have done is they have given a carve out to say that if 2/3 of your investors are actually giving you a permission not to contribute so much, then we as a regulator will not insist for it. So they are saying, because when they compared globally there's no such requirement, right? So if you are setting up something in US or Singapore, etc., there's no such requirement that you have to contribute something minimal, right? And therefore they're saying if your investors are allowing, if their investors have a confidence that your skin in the game is not required, or their skin in the game should be lower, like 1% of my overall fund, then based on whatever you've agreed with the investor, it is fine. But if the investor has not given any consent, then whatever has been prescribed in the regulation is what you need to commit in the GIFT vehicle, in the GIFT fund. And therefore, the next question will come is that, where will this funding come from? So for example, that $500,000 that we spoke about as net worth, right? That can be used to invest into the fund to meet your sponsor commitment, etc. Or the sponsor may have to put in additional money to be able to comply with this condition if they do not get the waiver from their investors. The other interesting thing which the authorities have been really maybe pushing for is that while this regime is great and maybe all the new funds would like to set it up, etc., they've also given a small window that if your fund is currently set up in an overseas country, and if you think that you want to relocate that fund to GIFT, then they have allowed for relocation provision as well, right? This is the classic objective of onshoring the offshore, right? So for example, for people who have set up funds traditionally in Mauritius, Singapore, who are all India groups, right? They have given an option that why don't you come to India? There is a regime available. We are giving you a very comparable environment in terms of tax and regulatory framework. And the good part is that they have given a tax exemption currently if you're able to relocate the fund before 31st March 2025. Okay, this sunset was there up to 24. Now they have extended for one more year to 25. We are hoping, based on the positive response, that this may get further extended. So, and this will be completely tax-free for the investors as well as for the fund managers. So this is another thing which a lot of people are very keen and interested to talk about, discuss. This could be your classic private fund. This could be a public fund. This could be any fund, right, that is currently setting up in Mauritius. What we also been hearing is that Mauritius has also started becoming very difficult as far as KYC and various other things is concerned. Or the cost of operation of a Mauritius fund or Singapore fund is probably way too high than what it is there in GIFT. right? And people saw during COVID times that it was not easy to cross land borders, go into that country, see how the activities are happening. So all of these factors have probably made compelling reason for people to look at it and say that why don't I create my fund or relocate my fund, which is much closer to here. It's 1 hour flight from Mumbai. It's accessible. You know how the activity is happening, and the cost of operation is also significantly lower as compared to what it could be there in Singapore and Mauritius. Yeah. So family investment fund, right? So this has been, maybe there was a time where this was like a buzzword around, where it was allowing a regime whereby Indian family groups or Indian family offices to invest outside India. Now, if you really see under the current regime, what is happening is there was a cap on how much an Indian entity could invest outside India. There was only a 400% of net worth, but that was requiring you to comply with multiple other requirements on whether you are investing in financial services or not. And thereafter, the new guidelines came in August 22, where they completely restricted any Indian unlisted entity to invest outside India, which is engaged more into portfolio investment, right? So that became restrictive, and therefore there was I would say, a little bit of vacuum on how Indian groups will invest outside India, invest in outside listed securities, etc. So this regime became very popular. What it basically means is that you could create what we call as a family investment fund in GIFT. This entity does not require a manager, right? Because it's your own prop capital or capital of the family together. It has a minimum requirement of $10 million over a 3-year period that you can create. And it has no restriction thereafter in terms of where and how the investment can be made from this particular vehicle. I think what happened is that when this regime was rolled out, everybody got very excited. Everybody started applying for it, etc. Because the limit really for anybody to invest into this could be 50% of the net worth, right? And that became very compelling for a lot of family of houses to set up presence in GIFT, because they could then take exposure to overseas securities. And then suddenly the regulators realized that they're not sure what they wanted to cover with this particular regime. And therefore, currently, this FIF is still being reconsidered and relooked in terms of what is that they will allow from an outbound perspective and what is that they will allow from an outflow of foreign capital is concerned. But hopefully the clarity should emerge soon, and this will then become very interesting to a lot of people who may want to take exposure to overseas securities as part of their diversification asset class. Coming to taxation, maybe I'll just go to the structure chart and explain the taxation. So taxation-wise, the tax works differently for a restricted scheme or what we call as a fund vehicle and for the manager vehicle. For the one vehicle, depending upon whether you are category 1, 2 or 3, the tax varies. So for category 1 and 2, the tax is very simple. It is a complete tax pass-through, very similar to what a SEBI regulation also has, that the fund does not pay the tax, the investor has to pay the tax as if they have directly invested, and the fund just has a withholding obligation. The good part that they've added here is that any investor who comes into the fund in GIFT, they don't require to obtain PAN or file any tax returns in India, right? So that also, they have given an added incentive so that there is no reluctance or hesitation for foreign investors to come in GIFT, because people are comparing themselves vis-a-vis a Singapore or a Mauritius, right? So if an investor would have come into a Singapore vehicle, then that investor would not require to file any tax return in India. And therefore, if they were to come into GIFT, if they have been given a same treatment or a level playing field, they'll be very happy and open to come into GIFT, because they feel that there is a lot of benefit otherwise that is available for investing in the GIFT vehicle directly. So complete tax pass-through for a category 1 and 2. Category 3 is slightly nuanced, and that is where I think there is a lot of interest which is coming from, I would say, players who invest in public market, especially when they invest in derivatives or credit or debt market. So the way category 3 fund taxation works is there the taxation is actually at the fund level. It is not a pass-through. However, they have given concessional tax rate that are applicable to the fund. So for example, if you're earning capital gains, then the rate of tax is flat 10% on equity shares. But if you're earning capital gains on any other security, like a bond, like a InvIT unit, REIT unit, all those other this thing, then the taxation is zero under the domestic law. which today for a foreign guy, that taxation is zero under the treaty. So what they have done is they have given a level playing field, but without the need for the foreign investor to actually rely on treaty. So which is a very compelling thing, because we all know that any treaty claim, right, it takes a lot of effort for anybody to go and show the substance and the rationale of getting the treaty benefits. So that benefit is now available under the domestic law itself. Similarly, dividend income. Today, any dividend to a foreign investor is taxable at 21%, right? 20% plus surcharge and cess. They have provided for a flat 10% rate of dividend for any money coming to this category 3 AIF in gift. And thereafter, any upstreaming of money from that category 3 to the investor is not subjected to further tax. So that's another concession that they've given. Similar to dividend, even for interest, they have given a flat 10% rate, right? So today, for example, for a foreign investor, if they were to earn an interest income in India, the tax rate could either be 21% if they are an FPI, or it could be 43% if it is a non-FPI entity. However, if that investor would have created a presence or a setup in gift and have taken a category 3 license, then their tax rate actually comes down to 10%. So which is another positive thing that they've given for foreign investor to come and try and set up the shops there. Moving slightly to the registered FME. The registered FME is a classic entity in gift. You could set up a branch, you could set up a private limited company, you could set up an LLP, right? Each of these vehicles may have different tax treatment. The blanket tax treatment is that it has a tax holiday from a normal corporate tax of 10 out of 15 years. So there is a zero tax absolutely. If you are set up as an LLP, then there is a AMT, which is an alternate minimum tax of 9%. But thereafter, when the LLP distributes that money to the partners, there is no further tax. So essentially, whatever income that an FME entity earns in gift, there's just a 9% tax on that. If you're setting up a branch, then the branch profits will get consolidated with the headquarter. And depending upon whether the headquartered entity is in MAT or not in MAT, the tax rate will vary. If they have adopted for the new regime, then to the extent of the branch profit, there will be a zero tax. So depending on the type of vehicle and the manner and the form that you're setting it up, there could be different tax treatment that may be available for a gift entity. Also, if you are a category 3 fund, what they've also allowed that if you had to exchange units, so if you were to transfer units to somebody else or exit out, there is no further tax in India on that. So they've given a benefit for a category 3 fund. Unfortunately, for category 2, it is still liable to tax in India, because that category 2, they are comparing very similar to how a Mumbai or a SEBI AIF category 2 as an entity operates. And because this is a FEMA regime, any entity which is a Cat 3 investing in public market needs to take an FPI license. You could be eligible for an FECI license as well, and you to comply with all the other conditions. So you could have a situation where the registered fund, right, in this chart as you see, the fund, the triangle itself could be an AIF as well as an FPI, right? And this is happening because of the, maybe I would say, hybrid nature of this vehicle, both from a FEMA and tax perspective. So this is all about FME. If there are any questions, I'll take a 1-minute pause. Then we'll go to some of the other opportunities that may be available in gift. But any questions on the FME side? Yeah. You're saying in the FME entity? So long as you are undertaking the activity which the regulation allows, right? As a registered FME, there are certain activities that is allowed and certain activities that may not be allowed. So long as you are complying with those activities, you should be eligible for tax holiday. It doesn't matter. There is a little of sensitivity on whether that entity could actually render services to an Indian vehicle, because the rationale of that vehicle is that either you are rendering services to a gift vehicle or to non-resident client. But it can't happen that you have set up a vehicle there but rendering services all to the Mumbai clients and Mumbai entity. Then you'll have a serious challenge on getting the benefit, because that's not what is intended to be set up in gift. I think one more question.
I have a basic question, sorry if it
Yeah.
sounds naive. So when we're talking about, when we say a gift entity, that would typically be the FME and not really the fund. So all the tax benefits that are flowing are actually to the FME, or unless you're talking about a
So,
Cat 3.
so I'll tell you, because what has happened is income tax has still not migrated completely to say that we will only look at the FME. Because if you really see under income tax, the fund vehicle and the fund manager are two separate taxpayers, two separate tax assessees. And therefore, the income of both of these vehicles need to be independently looked at it. So all the tax pass-throughs, tax status are given for the fund separately, which is where the Cat 1, Cat 2, Cat 3 license is relevant. And for the FME, which is the fund manager, it is like any other unit set up in GIFT, right? Whether it is a FME or a finance company or any other company, there is a classic 10 out of 15-year holiday. But for the fund, the regime is separate. So for Cat 1, Cat 2, there's a pass-through. And for Cat 3, they have specified a separate category called specified fund under the income tax law, where all of these tax rates have been provided. Yeah. Any question? I'll move. I think there was one question at the back. Yeah.
So Kunal, you indicated that there is no requirement of PAN. That has been dispensed with for the end investor. And the question that comes up is, because the registered financial intermediary or the fund would have to comply with FATCA CRS reporting, presumably therefore as part of KYC one would have to obtain the foreign TIN of the investor. Is that a fair assumption?
So sorry, I missed your last point. As a foreign
No,
entity, yeah.
The foreign TIN, will it have to be obtained? Because otherwise, without the foreign TIN, the
That is
FATCA
correct.
reporting does not go through
So typically, yeah, sorry.
for the investor.
That's correct. So investors, maybe incorporation document, their tax registration document in the home country is what typically they ask for, and not the India PAN.
Okay, thank you.
Yeah. Well, so currently under FEMA, while an Indian entity can invest in a gift fund which invests back into India, in fact, if you see current FEMA, they've allowed round tripping up to 2 layers, right? But the IFSC authority today is not encouraging a gift fund to raise capital from Indian investors and invest back into India, right? They are not kind of approving it unless the money is coming from sponsor or as part of the sponsor commitment. But otherwise today, they have made a very clear bifurcation that if you're taking Indian money, then you invest in overseas market, or you take overseas money which will come into Indian market. You can't kind of commingle the two. So again, family fund, again, the intent is for them to take more exposure outside India. See, family fund as a regime is slightly under review right now because the way some of those limits, etc., got used up, right? There is a little bit of relook that is happening as far as RBI is concerned. Whether they will allow the same fund to invest back into India, to invest outside India. See, because see, for family fund, to be very honest, they don't need a gift regime if they have to invest into India, right? So, because they are not like a third-party capital which is being managed by somebody. That's own my balance sheet money. So, for India, they're investing directly from India. It's gift that is allowing them to invest in overseas market, which is what is currently getting restricted under the August 22 overseas investment guidelines. Thank you. Yeah.
For NRIs investing into IFSC, I think if they do directly through FPI, there's some restriction. So do NRIs get an opportunity to invest in India through IFSC? Is that better as compared to direct?
So there is no different. As an NRI, the same regulation that applies for them to invest in a Singapore entity. Let's say, for example, you can't have an FPI with more than 49% NRI. Same thing applies for GIFT. They have not created that relaxation. Similarly, for NRI, if you are investing from NRO account, then the same level of restriction apply because it's still a FEMA zone. So to that extent, as far as FEMA is concerned, they have not made any distinction between NRI and non-NRI. From a tax perspective, maybe you may get a slightly different treatment versus what you get otherwise if you're investing in an overseas vehicle. Yeah. So very, very quickly a snapshot, I'll give you the benefit of the tax treaty, right? If you see most treaty, like for example, if you really see derivative in IFSC it is exempt, whereas for Cayman, it would have been 35%. All the other jurisdiction, Ireland, Singapore, Mauritius, it is exempt under the treaty. And when we say it is exempt under the treaty, now treaty requires you to have a TRC. As Ajay mentioned, it will be subject to MLI, GAR. various other things that one has to cross the bridge for you to get the treaty claim, right? Whereas all of these things is actually exempt under the domestic law itself. Similar thing happens for interest, right? And dividends as well. And capital gains, so equity capital gains, there is no benefit in gift. So if the objective is for you to only invest in equity type of investment, then there is no benefit that gift is offering. But for non-equity investment, there are multiple benefits that is possible. This is the fund ecosystem. You see all the big names which are currently set up. This is part of the overall 114 funds which are already set up in GIFT today. Very quickly, as you are all aware, there was maybe initially a draft consultation paper, and then it got converted into a regime whereby they are allowing Indian companies to list on IFSC exchange. Okay, so just to take a 30-second pause and maybe reflect back. See, today an Indian company cannot list anywhere overseas, right? The only way you can list an Indian company overseas is to have an ADR, GDR mechanism. And ADR is an American Depository Receipts and GDR is a Global Depository Receipts. That too, it is only permitted for a company which is otherwise listed in India. Like an Infosys would have an ADR in the US, right? Or somebody else like a Vedanta would have an ADR, GDR in the US. But if you have a private limited company, you cannot list overseas. So this IFSC regime had allowed for Indian unlisted companies to try and list on the IFSC exchange. There were certain benefits that were extended, and that was allowing greater accessibility, more participation from foreign investors. This is still under works because this also needs to comply with FEMA, tax, and various regulation. So this is still in works, and this one has to see how ultimately this will get implemented and what are the conditions. Basically, right now, the conditions which are applicable for any entity to list in IFSC is still onerous in terms of what should be the public participation, what should be the lock-in requirement, etc. So some of these things are still being worked out from an IFSC standpoint. A finance company, very quickly, is like any other NBFC that is set up in GIFT. It is allowed to lend in India, allowed to lend outside India. There are concentration norms, like for example, you can't have more than 25% exposure to one single group. And also there are capital adequacy requirement, very similar to how an Indian NBFC would be. But the good part is that this allows you to give dollar loans, right? You need to comply with ECB. There is a benefit on tax that one will get because any finance company will be subjected to tax holiday of 10 out of 15 years. And if you're in the new regime, then no tax. And if that finance company would have in turn borrowed money from or borrowed money in dollars from an IFSC bank or an overseas investor, then on that interest, there is no further tax that could apply. So you could really have a situation where the effective tax rate on such lending could come down significantly. And this regime is also getting popular in IFSC. Similar to finance company, there is something called as a Global Treasury Center. This is nothing but a type of a finance company, but restricted to pooling capital from group companies to invest in group companies. So where 2 or 3 groups have multiple entities within their group, they want to try and create that fungibility of capital, then you could set up a Global Treasury Center. Again, very similar tax treatment. The benefit of this is that there is no concentration norm, so you can invest 100% of your capital in one company or one group entity. And this could allow a lot of infra companies and infra players where they may have your main parent outside India but wants to fund capital to their Indian subsidiaries in a tax efficient manner. Then this creates a good platform for people to try and use that to invest some of the group companies which require capital in India. There's a minimum capital of $2 million, but all those are like, it's much diluted as compared to what a finance company would require. These are the type of activities that you can see that could do cash pooling, investment in group companies, collateral, everything actually what one would want from a financing standpoint, like a treasury operation that you create, right? A global in-house center. Now, this is very interesting. This is basically like a classic KPOs, BPOs that you see, but for only finance companies. So Bank of America, for example, has a very large GIC set up in GIFT with some 2,500, 3,000 employees. And there are many such other banks, finance company who are trying to set up their, what we could say, back office in GIFT. This is only permitted for a finance company. So you can't have a non-finance company set up a GIC in GIFT. That people have to still set up somewhere in Hyderabad, Bangalore, Mumbai, etc. But for finance company, for entities which are engaged in financial services, you can still set up a GIC. And the benefit of this is that you get a tax break, because whatever markup that you charge, you get a tax holiday depending on whether you're a company or an LLP. Worst case, you pay a 9% tax on that. There are certain benefit which Gujarat state has given from an ITS perspective. So that is also something that people can capitalize on it when they set up a GIC in GIFT. So these are some of the, so the other thing is FinTech, as we call it. You would all heard about FinTech currently, which is getting popular. But they have also now permitted TechFin, right? A TechFin is basically technology solution to finance company. So for example, an Infosys, which is actually providing services to a bank, could actually qualify as TechFin, right? A FinTech is a classic Paytm or a classic Pine Labs, who are otherwise having financial solution for their clients. A TechFin is actually a predominantly an IT company, but catering majority of their customers or largely the customer to financial services sector. So both of these are possible. They have created an incubator center. They're trying to promote all of these things in GIFT. Again, see, these are all picking up. I would not say there are a lot of players who have started jumping into it. Today, if you really see from an activity standpoint, the maximum activity that we see is from banks, right? From stockbrokers to an extent, and from fund managers. Fund managers is the most popular that you would have heard in a lot of cases, and aircraft leasing is also getting picked up. This is very interesting. I think this will probably interest a lot of people in this room. Is basically creating ancillary service framework in GIFT, right? And there is an ancillary service, and then there is a BAFT, which we'll talk about, bookkeeping, accounting, and taxation services in GIFT. So this is basically allowing service providers to set up presence in GIFT, right? If you are actually rendering services to a GIFT vehicle or to a non-resident client. You cannot set up something in GIFT which is rendering services to an Indian client. That is something which is not encouraged or is what IFSC authorities allow. So this is where you provide legal service, bookkeeping, accountancy, maybe management consulting, various things, right? All of this is ancillary services. What they have now done, right? So this ancillary services, actually, the way the regime works is only permitted for a financial services client. So you could set up an ancillary service entity, but you have to, your client has to be a financial service client, right? Because that's where this thing. But what they have now done is, recently, as Kabraji also mentioned, they have created a carve-out. They have created a carve-out within financial services for what we call as a BATF, which is bookkeeping, accountancy, tax, and financial crime services. This is keeping in mind the larger objective of the Prime Minister to try and make GIFT as a hub for the various services, right? And this allows you to provide bookkeeping, accounting, tax for all types of clients, whether financial services or non-financial services. So it's like a outsourcing arm, it is like a KPO arm, or it could be any arm that could be there. So if one has significant non-resident clients, if you have a lot of GIFT City clients, then one could look at setting up as a BATF in GIFT and try and capitalize on that ecosystem or the growing ecosystem which is going to come up in, or is likely to come up in GIFT already. Some of these names, all big names are there, many more names are coming up, all accountancy firms are there, lawyers are there, other administrative service providers are there. They're all currently set up in ancillary services because the BATF regime is very new. They have been all given a time of 3 years to migrate to BATF, so that becomes a more specialized type of activity, and then the ancillary services will largely be catering to professional or management consultancy and those kind of services. So these are the various opportunities from a BATF perspective. There you can see bookkeeping, a classic bookkeeping, reviewing, compiling, financial statement, financial crime compliance, which is FATF, as we spoke about. All of that can now be set up in GIFT for both financial services client as well as non-financial service client. Then there are accounting services that one can set up. There are taxation services. So for example, tomorrow you could actually create a hub in GIFT City which can help do all the US tax compliances, right? There is so much of buzz today going on creating KPOs or capability centers in India, which helps to probably do global taxation sitting in India, right? If you have the right team and the right resources, then you can actually outsource a lot of these work to an entity in GIFT. And last, I think very quickly, I'll not get into IBU because just on from keeping perspective of the time is, this is one of the other active platform that people are setting up. Both Indian banks and foreign banks can set up what we call as an IBU. IBU is like a classic branch who is set up in GIFT, like any other banking branch that is there. It can undertake any banking transaction, but all of this is a dollar denominated transaction. Rupee transaction is still not permitted. You could do derivative, you could do capital market investment, you could do lending, you could do various other things. There is a capitalization requirement, there is a licensing requirement, there is a lot more regulation because banks always have been governed in a much stricter way. So there is an oversight of RBI, there's an oversight of IFSC to that extent in terms of what activities you are doing. Tax-wise also, they have been given same 10 out of 15 years. They have been allowed to issue derivatives, and any income made out of what we call as a P-note or NDI is exempt from tax. So very similar benefit that is available to any other maybe overseas entity is available to this IBU setup in GIFT as well. So these are the capital gains. For equity, again, it is same as 10%, but for some of the other like derivatives and securitization trust or offshore securities, it's still a zero tax. So it still gives a level playing field as if you would have set up, say, a branch in any other foreign country. These are the IBUs which are already set up in GIFT. If you see, all big banks are there. I at least don't see any names which is missing because everybody wants to try and capitalize on the growing, I would say, growing need, etc. at the GIFT City level. So this was it. Thank you, everybody, for a patient listening. Thank you. You have time for questions? BSc.
See, I'm moving a little away from the protocol allotted to me. I request all of you who are just moving out, bear with us for the last 5 minutes. We'll just thank the speaker who has put in so much effort to address us and enrich us. Thank you. Before we move on to the vote of thanks, Murtuza Bhai Kachwala would like to make some announcements. Then we have the vote of thanks.
Thank you, Ghanshyamji. At the outset, let me first thank all the 8 speakers for this DTRC: Vimal Punmiya, Vishal Gada, Bawar Burana, Gautam Nayak, Nihar Jambusaria, Rajan Vora, and today Ajay ji and Kunal Bhai. So I think a big thanks, and I would request you all to carry it out with a huge round of applause. This is all selfless, free. They come all the way from various places, travel and share their knowledge with us. A big thank you to the WRC team for organizing this.